Hi, my name is Muhammad Faizi, and today I'm going to tell you about derivative market in Malaysia. First, what is derivative? Derivative is a financial contract whose value is on base underlying asset such as stock, commodities, currencies, and interest rate. This means the value of derivative change whenever the price of underlying asset change. Unlike traditional investment, investors do not directly own the underlying asset. Instead, they are linked to the asset's value in the future and future price movement. Derivatives are widely used in financial market around the world. They are for businesses, investors, and financial institutions. They can help market participants manage financial risk, protect against price fluctuation, and make decisions based on the future market expectation. There are 4 types of derivative contract. We got futures, option, swaps, and forward. Each type serves a different purpose, but is also commonly used in financial market to deal with uncertainty and volatile market condition. The first is futures, which are agreement of buyer and seller to sell an asset or buy an asset at a fixed price on a future date. Second, we got option. Option is when the holder have the right to sell or not sell the asset to the seller. Third, we have swaps, where 2 parties have their own agreement in order to exchange financial or cash flows. And 4, we have forward, which are customized agreement between 2 parties to buy or sell an asset in the future. Now, let's take a look at derivative market in Malaysia. In Malaysia, derivative market are traded through Bursa Malaysia Derivative, or called as BMD. It is the Malaysia official derivative exchange and provide a regulated marketplace for trading derivative product. BMD offers various products including FCPO or crude palm oil future, financial derivative, and equity derivative. Among these, FCPO is one of the most actively traded product because Malaysia are one of the world's largest palm oil producers. Bursa Malaysia Derivatives plays an important role by providing a platform where business and investors can trade derivative contract in a transparent and regulated environment, so investors feel safe with all the transparency.
Now that we have a general understanding of what derivatives are, I would like to bring us into the Islamic perspective, specifically how Islam views this instrument and the Sharia concern that arise from them. Why derivatives are controversial in Islam? Islamic finance is governed by Sharia law, which is rooted in the principle of fairness, transparency, and the prohibition of exploitation. There are few core prohibitions that directly clash with conventional derivatives. First is riba, the prohibition of interest or any guaranteed return without real economic activity. Second is gharar, which refer to excessive uncertainty or ambiguity in a contract. And third is maisir, which means gambling or speculation. Derivatives, by their very nature, often involve all 3 of these elements. When it comes to conventional derivatives such as option, futures, and swaps, Islamic scholars have raised several specific concerns. Take future contract for example. In a futures contract, you are selling something you do not currently own with delivery promise at a later date. This is known as bay' al-ma'lum, the sale of something that does not exist, which is generally prohibited in Islam. Then there are options. Paying a premium for the right but not the obligation to buy or sell something resembles gambling in the eyes of many scholars. You are paying money for a mere possibility, which introduces maisir. And interest rate swap are seen as a direct form of riba. Exchanging fixed rate, fixed interest payment for floating one is essentially trading in interest, which is clearly prohibited. That said, Islamic finance does not leave business without option. Scholars and financial institutions have developed Sharia-compliant derivative instruments to serve similar risk management purposes. These include Islamic Forex Forward, Islamic Forex Swap, Islamic Cross-Currency Swap, Islamic Profit Rate Swap, and Islamic Option. Each of these instruments is carefully structured to avoid riba, gharar, and maisir, ensuring that hedging and risk management can still be carried out within the boundaries of Sharia. So, in summary, while derivatives serve important economic functions, they present a real challenge from a Sharia standpoint, primarily due to gharar, maisir, and riba. The Islamic finance industry continues to develop instruments that achieve the same risk management goals while remaining true to its ethical foundation.
Islamic Profit Rate Swap, or IPRS, is a Sharia-compliant hedging instrument used by Islamic financial institutions to manage profit rate risk. In an IPRS arrangement, one party agrees to pay a fixed profit rate while the other party pays a floating rate. This allows both parties to protect themselves from unexpected changes in market profit rates. As shown in the diagram, the exchange of fixed and floating profit rates helps reduce exposure to profit rates fluctuation. As a result, financial institutions can stabilize their cash flows and earnings, making their financial performance more predictable. Another important benefit is that IPRS complies with Sharia principle because it is structured using approved Islamic contracts rather than interest-based transactions. Therefore, Islamic Profit Rate Swap serves as an effective risk management tool while ensuring compliance with Islamic financial principles. Malaysia is recognized as one of the leading countries in the development of Islamic derivatives. The Islamic Profit Rate Swap is designed to comply with several key Sharia principles. First is tawarruk, where a series of commodity purchase and sale transactions are conducted to generate the required cash flows. Second is the risk management purpose. Islamic derivatives are intended to hedge genuine business risk and not for speculative activities. Third is asset-based transaction principle. Every transaction is supported by an underlying commodity, ensuring compliance with Islamic commercial principles. Beyond financial institutions, Islamic derivatives are also provide significant benefits to businesses. They help companies manage profit rate risk and foreign exchange risk, reduce financial uncertainty, protect cash flows and profit, and ensure that all risk management activities remain Sharia compliant. Overall, Islamic derivatives play an important role in supporting financial stability and business growth while adhering to Islamic principles.
Next, I will explain the opportunity of the derivative market. First, risk management, also known as hedging. Derivatives can help investors and business reduce their exposure to financial risk. They can protect against unexpected price change in asset, commodities, interest rate, or foreign exchange rates. This protection helps to minimize potential losses when market conditions become unstable. As a result, business can enjoy greater financial stability and make better financial planning. In addition, derivatives help companies manage market uncertainty and continue their operations with more confidence. The second opportunity is profit opportunities. Derivatives allow investors to benefit from change in market price. Investors can earn profit if they correctly predict whether the price will rise or fall. This creates opportunity for speculative gains and can increase potential investment returns. Furthermore, derivatives provide access to different financial markets, giving investors more investment choices. They also enable flexible trading strategies, allowing investors to adjust their decision according to market conditions and investment objectives. Next, the other opportunity is protection against currency fluctuation. Derivatives help business reduce foreign exchange risk caused by change in currency value. This is very important for companies involved in international trade. By using derivatives, business can protect their international transaction from unexpected exchange rate movement. In addition, derivatives help stabilize import and export costs, making expenses more predictable. This improves certainty in cross-border business activities and help companies maintain their profit margins even when exchange rates change. And the last opportunity is better financial planning. Derivatives improve budgeting accuracy by helping business estimate future costs and revenue more effectively. They also assist companies in forecasting financial performance and preparing for future market conditions. Furthermore, derivatives support long-term business planning by reducing uncertainty. This allows managers to make better decisions based on more reliable financial information. As a result, business can achieve greater predictability in their financial operation and manage their resources more efficiently.
One of the examples for liquidity challenge is called the catch-22. The problem is big investors like banks, insurance companies, or hedge funds managers have a lot of money to trade, but they refuse to use a new exchange if it has a low liquidity because they are afraid that they will get stuck with an investment and won't be able to sell it when they need to. However, the exchange cannot get liquidity unless this big investor can join and start trading. In short, big investor will join until the market is busy, but the market won't get busy until the big investor joins. If a new exchange cannot break out of this loop, the exchange will not grow, and it will remain small, quiet, and ineffective, because people are too afraid to take the first step. The next challenge involves Sharia concerns. Sharia boards often impose strict conditions, for example, proof of underlying exposure or prohibition of trading derivatives freely for profit, which in turn limits flexibility and secondary market activity. So, even if a structure is technically Sharia compliant, the perception problem slows real-world adoption. Other than that, many conventional derivatives such as forward futures, options, and swaps involve elements of gara, which is excessive uncertainty, and maisir, which is speculation or gambling, and sometimes riba, which are prohibited in Islamic law. Lack of public understanding also becomes a challenge to derivative market. Not all market participants such as bankers, treasurers, and corporate clients fully understand both Sharia principles and modern derivatives theory, making it hard to design and use products correctly. Last but not least, Malaysia has supportive regulators such as FIN546 and SC, and has introduced some guidelines and standards for Islamic hedging products. But the challenge remains. Standards for Islamic derivative, for example, how to use wa'ad or profit rate swaps, are still evolving and sometimes differ from standard used in GCC countries. Different interpretations of Sharia and different contract templates across institutions create legal uncertainty and increase documentation time and cost. But there are recommendations that can be made to improve the derivatives market. First one is encourage key players such as Islamic banks, government-linked funds, and large corporate to act as a market makers in core Islamic derivatives, so there are always quotes in the market. Also, support central clearing or organized platform for Islamic derivatives where possible to reduce counterparty risk and make trading more attractive and transparent. Next, national level Sharia bodies like BNM and SC Sharia Advisory Councils can issue more detailed and harmonized guidelines on when and how derivatives are allowed for hedging, similar to what has already been done for FX forwards. Proof of underlying exposure will help reduce uncertainty and give banks confidence to develop products. Derivative market can also provide more specialized training for Islamic bankers, treasury staff, Sharia officers, and regulators on both derivative theory and Sharia aspects, so they can design and monitor products effectively. Run simple practical education for corporates and fund managers. For example, how an Islamic FX forward works, what documents are needed to increase demand. Derivatives market can also be strengthened by continue and strengthen joint working groups between Bank Negara, Securities Commission, Sharia councils, and industry players to regularly review and update the operational framework for Islamic derivatives in Malaysia. Align Malaysian standards such as much as practical with international bodies, for example IFSB, so that Malaysian Islamic derivatives cash can be more easily used in cross-border transactions.
In conclusion, derivatives are important because they help manage financial risk and uncertainty. However, conventional derivatives may involve riba, gharar, and maisir, which are prohibited in Islam. Therefore, Islamic derivatives provide Sharia-compliant alternative for businesses and investors. Although the market still faces some challenges, it has strong potential to grow in the future. Overall, Islamic derivatives support effective risk management while maintaining Sharia compliance. Thank you.